Hi everybody, this is lecture for topic 3 and also for topic 4. Okay, this is the first lecture for week 6. Topic number 3. So the first thing in this topic is you will learn about the step 5 in the accounting cycle. The step 5 is doing adjusting entries. After that, you will learn about step 6, which is preparing an adjusted trial balance, and then you will learn about step 7. Step 7, 6, 7. Step 7 is preparing the financial statement, and step 8 is doing closing entries. In some textbooks, say that step 7 is the closing entries and step 8 is the preparation of financial statement, but that is not very important. So let's see how to do the adjusting entries. Okay, before you learn about step 5, doing adjusting entries, you have to know several things. The first thing is this is related to the accounting assumptions and principles that you have learned in topic 1. Okay, one of the assumption and principle that you have learned in topic 1 is called periodic reporting or time period assumption. Okay, the assumption of or principle of time period says the life of a business can be divided into several periods, or the life of a business can be divided into accounting periods. Okay, so the thing is like this. In accounting, we divide the life of a business. We assume that the life of the business we assume that a business will continue to operate in the future, but we divide the life of the business into accounting periods. So according to accounting standard, a business has to close its account at least once a year. When a business closes its account, the business can calculate profit or loss. So if you have a business, according to the accounting standard, you have to close your account at least once a year. But if you want to know the profit of your business every month, you can close your account every month. Or let's say you want to know the profit of your business every 3 months, you can do that also. But according to accounting standard and regulation and law in many countries, at least once a year a company has to close its account to calculate profit and also to pay tax. Okay, so this is see this like financial year, 12-month accounting period. That's the thing that I said. If you have a business, it is compulsory for you to close your account at least once a year. If your business started operation in January, you have to close your account in December. That is compulsory, 1 year. And let's say in this slide, you have a business, you started the business in April. So if you started the business in April this year, you have to close your account at the end of March next year. That is the compulsory period, 1 year. Okay. Okay, this remember this. And then after that, The second thing that you have to know, sorry, let's see. Okay, the second thing that you have to know, another thing that you have to know before you can do the adjusting entry is you have to know that in accounting we have two bases. You can do accounting record using accrual accounting or accrual basis, or you can do accounting record using cash basis. Okay, what is an accrual based accounting? So accrual based accounting is like this. Accrual based accounting is you record revenue and expenses when they happen, when the transaction happen, or when they are earned, not when you receive cash or you pay cash. Okay, remember this. Accrual basis accounting is like this. When you use the accrual basis accounting to do recording, you have to record revenue when the transaction happen, not when you receive cash from customer. And also you have to record the expenses when the transaction happen, not when you pay cash to somebody or to other businesses. So this another basis of doing accounting is called cash basis. Okay, if you use cash basis accounting to do the recording process, you record revenue when you receive cash from customer, and you record expenses when your business pay to somebody or other parties. So in general, we can say that accrual basis accounting is more accurate, because using accrual basis accounting, you record the transaction for a business when they happen, when the transaction happen, not when you pay or you receive cash. But if you use cash basis accounting to do the recording, it is not very accurate if you want to see performance of a business in an accounting period, because when you use cash basis accounting, you record cash in and cash out. You record cash in and cash outs that happen in a business. Because when you use the cash basis accounting, you record the revenue when you receive cash, and also you record expenses when you pay cash. So later you will see an example, and I hope you can see the difference between cash basis accounting and accrual basis accounting. Okay, the thing that if a business do all the transaction in cash, then there is no problem. Let's say you have a laundry shop, and then you do all the transaction in cash. If a customer come today, you provide the service, and then the customer will pay cash. So there is no problem, because when you provide the service, the customer pay cash. If you use accrual basis accounting, you record at the same time, because you record the revenue when it happen. And also, if you use cash basis accounting, you will record at the same time, because cash basis accounting record revenue when the business receive cash. There is no problem. But the problem or the difference will happen when you have a business and your business do transactions in credit. Okay, let's say you have something like this. You have a laundry business, and then you provide credit, or you give credit to your customer. So let's say You have a laundry business today, a customer come and you provide services, and then you charge the customer $100. And then the customer say he will pay at the end of the month, at the end of this month. So if you use accrual basis accounting, you have to record the revenue $100 today, because according to the accrual basis accounting, you record revenue when the transaction happen. The transaction happened today. You have provided the service today, so you record the revenue $100 today. But if you use cash basis accounting, you will record the revenue at the end of the month, or you record the revenue when the customer pay, when you receive the cash from customer. So that is the difference. If the customer pay this month, then it is not a big difference, because the revenue is still this month's revenue. But the thing that can happen is you provide the service today, but the customer pay next month. So then there will be a difference in the calculation of profit. Remember, in accounting we have when you want to calculate profit, the basic formula is revenue minus expenses. Okay, remember that. Okay, accrual basis accounting. So another thing that you have to know before you can do adjusting entries is this one. Remember about this revenue recognition principle. The revenue recognition principle says you have to record the revenue, or a business has to record revenue when the transaction happen, not when the business receive cash from customer. Revenue recognition principle is consistent with the accrual basis accounting. Okay, so that is the simple explanation for it. When in accounting, you have to follow this principle. This revenue recognition principle says you have to record revenue when the transaction happen, not when the business receive cash from customer. The same thing applies to expenses. In accounting, you record an expense when the transaction happen, not when you pay the cash. Let's say, for example, like this. You have a laundry business and then you have one worker. Every month you pay this worker $1,100. Okay, the salary for this worker is $1,100. So let's say this is the month of November. So at the end of November, 30th of November, the worker has worked for 1 month. He has worked for the month of November. But your practice is, let's say your practice is you will pay the salary at the 5th of December. So it is like this. If the worker work this month, you will pay the worker next month. So the worker has worked in November 2020. You will pay him on the 5th of December 2020. So the question is, let's say you close your account at 30th of November. So when is the time to record the salary of this worker? 30th of November or 5th of December? Okay, in accounting, remember this. You record revenue and expenses when the transaction happen, not when you receive or pay cash. So for this salary expense, if you have a business, you have to record the salary expense at the 30th of November. not at the 5th of December. Because just memorize this, because in accounting we record the an expense when the transaction happen. The workers has worked in November, so you have to record the expense in November. There is a way to record that. Later, when you do the adjusted entries, I will show you how to do this kind of to record this type of transaction. Okay, this is another thing that you have to know before you can do adjusted entries. Remember this, the matching principle. Okay, the matching principle, the simple explanation for matching principle is like this. If you want to calculate profit for one accounting period, you have to match revenue for that period with expenses for that period. You cannot add revenues from other accounting periods in the calculation, and also you cannot add expenses from other accounting periods into that calculation. So for example, like this, let's say this is year 2020, and then at the end of the year you want to calculate profit for this year. So when you want to calculate profit for this year, remember you have to the calculation of the formula to calculate profit is revenue minus expenses. So when you want to calculate the profit for year 2020, you have to match the revenue for year 2020 with expenses for year 2020 only. You cannot add revenue from year 2019 or 2021 into the calculation. And also you cannot add expenses for year 2020 or year 2019 in that calculation. Remember, when you want to calculate profit for one accounting period, you have to match revenue for that accounting period with expenses of that accounting period only. Okay, this is an example of accrual basis accounting and cash basis accounting. You can see the different between these two bases of accounting in this sample question. So let's see. Okay, let's see this question. In year 2019, Bond Consulting billed its client for 48,000. Bill its client means this business has provided services to this client. When a business has provided services to clients, the business will send bill. The bill is an evidence that services have been provided. It is like you eat in a restaurant. When you eat in a restaurant, after you and then you are ready to pay, you will ask for bill. The bill is an evidence that the restaurant has provided services. Okay, like this one, the business has sent the bill to clients, 48,000. So it means that the business has provided $48,000 services to clients. On December 31st, 2019, it had received 41,000 with remaining 7,000 to be received in 2020. So, services that have been provided is 48,000, but the business received cash only 41,000. Some of the customers, maybe, of the client, will pay 7,000 balance in the next year. Total expenses during 2019 were 31,000, with 3,000 of this cost has not been paid yet at 31st of December that year. So during the in 2019, total expenses is 31,000. But at the end of the year, at 31st of December, the business still have unpaid $3,000 expenses, so still unpaid. So let's say if this is the situation, then how to calculate profit using cash basis and accrual basis. So see the bottom or the second half of the slide. See the cash basis accounting. If you use cash basis accounting to calculate profit, then this is the calculation. So remember the formula to calculate profit is revenue minus expenses. So if you use cash basis accounting, the revenue for year 2019 is equal to 41,000. Why? Because cash basis accounting says revenue is the cash that you receive from customer. So for this business, the cash that the business has received from customer or client is 41,000. So revenue equal to 41,000 minus the expenses. The expenses according to the cash basis accounting is cash out or cash payment. For this business, in the year 2019, the business has paid total expenses 31,000, but there is a balance of 3,000, so the business has paid $28,000. So if the business use cash basis accounting, then the profit is $41,000 revenue minus $28,000 expenses. The income or profit is equal to 13,000. And then, okay, let's see the difference. Then the next thing in this slide is the calculation of profit using accrual basis accounting. So remember this. If you have to calculate profit using accrual basis accounting, remember that in accrual basis accounting, you record revenue when the transaction happen, and also when you record expenses when the transaction happen. So revenue according to accrual basis accounting is 48,000. Why 48,000? Because during the year the business has provided services of $48,000 to client. And then expenses is $31,000. Why $31,000? Because during that year, the thing that happened is the business has made expenses with the value of $31,000. So according to accrual basis accounting, the profit is equal to 17,000. So now we compare these two. Remember this. In general, in accounting, we say that accrual basis accounting is more accurate. Is the accounting basis that is more accurate for measuring the performance of a business in one accounting period. Cash basis accounting is less accurate if we want to measure the performance of a business, because cash basis accounting shows cash in and cash out. It does not really show the profit of the business. It shows only cash in and cash out. Accrual basis accounting shows what had happened during an accounting period. You can see there in this example, it shows exactly what had happened in the year 2019 for this business. So remember that. And the second thing is, according to accounting standard, the only acceptable method of recording is the accrual basis accounting. For financial accounting, we have accounting standard. If you have a business, then you have to do accounting record, remember, if you have a business, you have to do accounting record, you have to follow accounting standard. For financial accounting record, you have to follow financial accounting standard. All businesses out there, when they have to do accounting record and then they have to prepare financial statement, they have to follow accounting standard. Every business out there has to follow accounting standard. That is for financial accounting. But for management accounting, there is no need to follow any standard. Okay. Okay, here. Now, step 5, adjusting entries. This is the thing that you have to, this is the step 5 in the accounting cycle. Doing adjusting entries. Okay, remember this. The main purpose of doing adjusting entries is to follow matching principle. If somebody asks you why a business has to do adjusting entries, the answer is the business has to do adjusting entries because the business follows the matching principle. The matching principle says if a business want to calculate profit for one accounting period, then the business has to match revenue for that period with expenses for that period only. And then the second reason why a business or why adjusting entries have to be done is to make correction. Correction if there are errors in the accounting record. Okay, so let's see. These are the typical types of adjusting entries. The first type of adjusting entries is unrecorded receivable. The second type is unrecorded liabilities. The third type is prepaid expenses, and then type 4 is unearned revenues. And then in this course, you will learn 2 additional adjusting entries. One is adjusting entries for depreciation, and another one is adjusting entries for supplies. Okay, you will see that later. And then second point in this slide, each adjusting entry involves at least one income statement account and one balance sheet account. So income statement accounts, there are 2 accounts related to income statement. Income statement, revenue and expenses. Income statement is a statement that shows profit or loss for a business. So the 2 accounts that are related to income statement is revenue and expenses. And balance sheet shows the performance. Balance sheet shows the financial condition of a business. There are 3 accounts related to balance sheet. The first one is asset, and then the second one is liabilities, and then the third one is equity, owner's equity accounts. Okay, when you do the adjust entry, there are 3 steps. Okay, these 3 steps is like this. The first one is you have to know the original entry. You have to know the first transaction that happened related to the adjusted entry. The second step is you have to determine what the correct balances should be at this point in time. You have to know what is the correct amount. for one account when you close the account. Okay, later you will see the detail. Number 3, make the adjustment needed to correct the balances. Okay, these are the 3. Okay, let's see this example. This is an example of adjusting entry for unrecorded receivable. Okay, the situation is like this. Precision Management earns rent revenue of 500 in 2019, but will not receive the payment until January 10, 2020. An adjustment will be needed. What is the adjusting entry? Okay, the thing is like this. There is a business. The name of the business is Precision Management. The business has rented a space in year 2019. Let's say the December 2019. So when the business rented a space, then the business will get revenue from the person who rented the space. The thing that happened is like this. The person has rented the space in year 2019, but the person will pay the rental in 10th of January 2020. So when the business closed its account at 31st of December 2019, what is the adjusting entry that has to be done? Okay, the adjusting entry is like this. Okay, remember, when you want to do the adjusting entry, the purpose of doing adjusting entry is, the main purpose of doing adjusting entry is to follow matching principle. The $500 that the business will receive on January 10, 2020 is the revenue for year 2019 or 2020? Okay, the answer is the revenue, the $500 is the revenue for 2019. Why? Because remember the thing that we have seen in the previous slide, in accounting, you record revenue when the transaction happen, not when you receive cash. So the rental has happened in year 2019. So you have to record that revenue, rental revenue, in year 2019. So this kind of transaction, the adjusting entry is like this. When the business closed its account at 31st of December 2019, the business has to record the revenue. Remember how to record the revenue. To record the revenue, you have to credit the revenue account. So at 31st of December 2019, the business has to record the revenue. The record is credit rent revenue 500. Because given that the business has not received the cash yet, the business cannot debit account cash. So the business has to debit account rent receivable. Rent receivable means an account in which the business record that in the future, in year 2020, the business will receive 500. Rent receivable is an asset because it shows that the business will get something in the future. So the adjusting entry for this situation is credit rent revenue, because the business has to record the revenue when it happened in year 2019, and then debit account rent receivable. Why debit account rent receivable? Because the business does not receive cash yet, but the business will receive the cash in year 2020. Okay, the second example, this one is the second type of adjusting entry, unrecorded liabilities. There is a business, and then this business is assessed property taxes of $1,000 for year 2019, but will not make this payment until 5th of January 2020. What is the adjusting entry has to be made when the business closed its account at 31st of December 2020. So the situation is like this. There is a business, and then the business knows in year 2019 the property the property taxes that the business has to pay is $1,000 for the year 2019. But the practice of paying tax is like this. You pay this year tax next year. So, the property tax, $1,000, is for year 2019, but the business will pay in year 2020. So, when the business close its account at 31st of December 2020, the business has to do an adjusting entry for this. Why do the adjusting entry? Because the business follow the matching principle. So the question is like this: before you do the adjusting entry, this $1,000 is an expense. Okay, in accounting, tax is an expense. Let's say you have a business, you have to pay tax. That is an expense. We call it tax expense. Okay, so this is an expense. So the question is, when the business closed its account at 31st of December 2019, this tax expense is an expense for year 2019 or 2020? The answer is, this $1,000 is a tax expense in year 2019. Why? Because it happened in year 2019. The property is owned by the business in year 2019, and the tax is relevant for the year 2019. So, how to do adjusting entry for this situation? So, given that the $1,000 is an expense for year 2019, then the expense has to be recorded in year 2019. When the business closes its account at 31st of December 2019, the business has to record the property tax expense of 1,000 in year 2019, because it happened in year 2019. So remember, when an expense increase, you have to debit the account. So the way to do the adjusting entry is debit property tax expense, $1,000. That is the first entry. The second entry is, the business will have to pay the $1,000 next year. So this is a liability for the business. If you have a business and then at one time you have to pay something in the future, that is a liability. So you have to, the thing that happened here is an expense increase. The second thing that happened is a liability also increase. Why liability increase? Because the business has to pay something in the future. So in accounting, we use account payable to record for this kind of liability. So the second entry for this journal is credit property tax payable, 1,000. You debit the expense, you record the expense account, which is the property tax expense, 1,000. And the second thing that you have to do, you have to record an increase in liability. So the name of the liability in this situation is property tax payable, $1,000. So payable is always a liability. Receivable is always an asset. Okay, this is the next thing. This is an example of adjusting entry for prepaid expenses. Okay, for this type of adjusting entry, you have to follow the 3 steps. Remember, there are 3 steps in doing the adjusting entry in the previous slide, so you have to follow that. Okay, let's see here. On 1st of October 2019, Apex Incorporated pays 3,600 for 1 year's rent in advance, covering 1st of October 2019 to September 30th, 2020. On December 31st, 2019, the business closed its accounts, and adjustment or adjusting entry has to be made. Okay, so how to do that? How to do adjusting entry for this kind of situation? So see the transaction again. On October 1st, 2019, this business pays 3,600 for 1 year's rent in advance. So this is a good business. It pays rent in advance from 1st of October 2019. So 1 year. So the rent covers from 1st of October 2019 to 30th of September 2020. This is a good business. And then at 31st of December 2019, the business closed its account. The business want to calculate profit, want to prepare the financial statement. So how to do the adjusted entry for this? Okay, so the logic is like this. When the business pay 3,600, that is not an expense yet. We call it prepaid. It is a prepaid. When the business pay 3,600, it is a prepaid expense. It is an asset because the business pay today, but the business can use the building for the next 1 year. So if the 3,600 is for 1 year rent, how much is the rental expense for every month? The rental expense for 1 month is 3,600 divided by 12 months. So 1 month rent is $300. And then see this. The next thing is, in the year 2019, how many month the space or building has been used? So the space or building has been used by this business for 4 months. October, November, and December, 3 months. Okay, so if the business has used the building or space for 3 months, how much is the rental for 3 months? We have calculated before. 1 month rental is $300. So if the business has used the building for 3 months, then it is equal to $300 times 3 months, so $900. Okay, so when the business closed its account at the end of the year, at 31st of December 2019, the business has to record rent expense equal to $900. Because the thing that happened in year 2019 is 3 months, and 1 month rental is $300. So the rental expense for the year 2019 is only $900. So let's see. So remember this, when you want to do this adjusted entry for this prepaid expenses, first you have to know the record when the transaction happened, when the transaction originally happened. So the original transaction is like this. October 1st, 2019, the business pays $3,600 for 1 year rent in advance. So remember, I have told you, when a business pay an expense in advance, you have to record it in accounting. You have to record it as an asset. In this situation, in this example, the situation is like this: the business pay the rental 3,600 at 1st of October. After that, the business can use the space or building for 1 year. It is an asset, because the business will get benefit in the future. So you have to record it as an asset. The name of the asset is prepaid rent. So when the transaction happen, the record is debit prepaid rent, because asset increase. and then credit account cash, because the business pay cash out. There is a cash out. So that is the original entry at 1st of October 2019. The second step is you have to calculate for year 2019 how much is the rental expense. So we have calculated that before. 1 month rent is $300. In year 2019, the business has used the building or space for 3 months. So rental expense for the year 2019 is equal to $900. So how to do the adjusting entry to record the rent expense? So you have to record the $900. So rent expense increases $900. So remember, according to the rule of debit and credit, if an expense increases, you have to debit or credit. So you check the rule, and then you will see that if an expense increases, then you have to debit the account. So the adjusting entry is debit rent expense, and then credit prepaid rent. Why you have to credit the prepaid rent? Because when the transaction happened at 1st of October, when the business pay the rent in advance, you record the prepaid rent 3,600. That is, this amount is an asset. At the end of the year, 900 from this asset has become an expense. So that's why you record the expense 900, you debit the rent expense account, but the prepaid has decreased because you have used the prepaid. So you have to credit the account prepaid rent 900. Okay, remember that. At the end of the year, when you do the adjust entry, you have to follow matching principle. The matching principle says for this situation, the business has to record the expense in the year 2019. So record the expense, debit rent expense, but you cannot credit account cash because the business has paid the cash in 1st of October. So you cannot credit account cash. You credit account prepaid. The prepaid account is an asset. So when the you record the $900 rental expense, the prepaid has decreased. Okay, this is the type 4 of the adjusting entries. This is called unearned revenues. Okay, so let's see the example here. In 1st of March 2019, Dal House Company received 3,600 for 1 year's rent in advance. Okay, now this business rented a space to another party. So when a business rented a space to another party, it means that the rental is revenue. It is a rental revenue. In the previous slide, it was rental expenses. Now it is rental revenue. Okay, so the thing that happened is at 1st of March, the business has received $3,600 for 1 year rent. On 31st of December, the business closed its account at the end of the year. So the business has to do adjusting entry. How to do the adjusting entry? So for this kind of adjusting entry, the step is like the thing that you have done in the previous slide. The first step is you have to know the original entry or the journal entry when the business received cash at 1st of March. Okay, this is the way to record the transaction at 1st of March. When the business received cash on the 1st of March, the thing that the business has to do is to debit account cash. let's say this is your business. When your business receive cash, the asset cash increases, so you debit account cash. So here for the, you can see here in this slide, debit account cash, and then the second thing that the business has to record is credit account unearned rent. Okay, unearned rent is a liability account. So this business, when the transaction happen on the 1st of March, the business has to record first increase in asset cash 3,600. The second record is credit account unearned rent 3,600. Why the 3,600 is a liability? Because it is a liability because the business received the cash, but the business has to allow another party to use the space or building for the next 1 year. It is a liability. It is an obligation for the business to allow the rented building or space to be used by another party for the next 1 year. That's a liability. That's why 1st of March, the business has to debit account cash, credit account, liability called unearned rent. And then now, the business has to close its account at 31st of December 2019. So now, how much is the rental revenue for every month? The rental revenue is $300 every month because 1 year $3,600. So you divide by 12 months. 3,600 divided by 12 months equal to $300. So rental revenue every month is $300. When the business receive cash, all $3,600 are liabilities, are a liability. But when the business close account at the 31st of December 2019, how much from these liabilities has become revenue? Okay, so to calculate how much has become revenue, then you have to calculate how many months has passed, how many months other parties has used the building or space owned by this business. So if the payment made on the 1st of March 2019, when the business closed account at 31st of December 2019, how many months has passed? March, April, May, June, July, August, September, November, December. So the building or space has been used by another party for 10 months. Isn't it? 10 months has passed during the year 2019. So 10 months. So from the liability of 3,600, how much has become revenue? So 1 month is $300 revenue. The building has been used by the party that rented the building for 10 months. So 10 months times $300 per month revenue, the total revenue is $3,000. So 31st of December 2019, you have to record the $3,000 as the revenue. Okay, so this is the way to do the adjustment entry. At the end of the year, you know that 10 months the building has been rented, so it becomes revenue. So revenue, if you check the rule of debit and credit, when there is an increase in revenue, you have to credit revenue account. So for this business, $3,000 from the liability of unearned rent has become revenue. So you have to record the revenue. So you credit account rent revenue 3,000. When the 3,000 has become revenue, the account unearned rent has decreased. Before this, when the business received the cash, the unearned rent or the liability is 3,600. After 10 months, 3,000 has become revenue, so the liability has decreased. So when the liability decrease, you have to debit. So you debit account unearned rent 3,000. So the balance of the liability unearned rent equal to 600. So this is the end of lecture 1 for this week, week 6. Do not forget to write your name and matric number in the comment section. And thank you very much.